All right, what is a Roth IRA conversion? What's a Roth conversion? Well, first off, you're going to move money from a pre-tax account to a tax-free Roth IRA. And you're going to, when you do that, that conversion from pre-tax account to a Roth is taxable as income. So whatever your tax rate is for that on top of your current income, you're going to add the Roth conversion. So and you're not avoiding the tax, but you're paying it in today's dollars. You're choosing when to pay it. I'm going to pay that tax now. All right, so the three flavors of a Roth: direct contribution, put after-tax dollars into a Roth each year, limited to $7,000 a year if you're under 50, and if you're over 50, it's $8,000. You get a little catch-up. Okay. Second option is a Roth conversion. Right? Again, you're just taking it from a pre-tax account over to a Roth account. There's no income limits there, and there's no cap. You can do as much as you want. And the last one is a mega backdoor Roth, and that's an after-tax 401k contribution that then gets converted to a Roth. And you can do up to $46,000 there if your plan allows. So those are the three main ways to do a Roth. The fine print on this, you got a 5-year rule. Each conversion has its own 5-year clock before earnings can be withdrawn tax-free. Really important. So you put money in, you got to wait 5 years before you take the money out. Otherwise, there's tax consequences. The other one, just like all IRAs, got to wait till 59 and a half to make your withdrawals. Otherwise, you get a 10% penalty on the conversion amounts. Secondly, you can do what's called a 72T to get money out of that prior. That's the same with a regular IRA. No recharacterizations. So since 2018, anytime you do a conversion, there's no way to reverse it. So you really have to plan well. You need to know exactly what that conversion is going to do to your tax liability. The pro rata rate rule. Here's how this works. Doesn't matter how many IRA accounts you've got or how many pre-tax accounts you've got. If you're doing conversions, they just add all of the conversion money away. So if you do 20 here, 20 here, 20 here, and it's $100,000 total, it's $100,000 that's going to get added to your income. So what you now know, you got Roth conversions moved from pre-tax to a Roth. You pay the taxes now, and it grows tax-free. There's 3 paths to the Roth: direct contribution, conversion, and the mega backdoor. And then conversions are permanent. That's real important because sometimes people make mistakes and they want to reverse it, and you can't do that. Remember that 5-year rule. Got to wait to 59 and a half to take the money. And then the pro rata rule, which just means all of those conversions are added together into one bucket. So the question we have is, why convert? Why should you do a Roth conversion? Well, there's 8 reasons that it can pay off for you and your spouse and your heirs. So let's go through this. The number one reason why you should consider a Roth conversion is this: we want to tax the seed, not the crop. If you were a farmer, right, and you had a chance to pay tax on the seed, or you could pay taxes on the harvest, you would want to pay tax on the seed. That's a lot smaller volume. So let me give you an example. You got a traditional IRA, and we're talking about taxing on the harvest. If you have a $100,000 seed you deposit into account, it grows to $500,000 over 20 years. Now you're going to pay taxes on the $500,000. So at 24%, that's $120,000, Uncle Sam. Or we could tax just the seed. $100,000 gets converted. You pay 24% of $100,000. That's $24,000. It grows to $500,000, all tax-free. So no taxes on the $400,000 of growth ever. So same crop, same field, but pay taxes on either $100,000 or $500,000. All right, the second reason is growth. It's never taxed again. And this is really important because the traditional IRA, over time, eventually you're going to have to start taking RMDs. And what those RMDs cause is they cause you to have tax liability. Not only do they cause you to have tax liability on just the income that gets pulled out, they're going to raise your tax liability on Social Security. It could expose you to IRMA, right? There's all kinds of reasons. But if you move that money to a Roth, all of that growth is then tax-free. So the longer the runaway, the bigger the gap. In other words, the more timeline you have, the more advantageous that Roth is going to be because the growth is all tax-free versus the IRA. Number 3, the fiscal backdrop, right? So this has to do with where our country actually is today. $38 trillion. That's the national debt, and it's climbing fast. There's $1 trillion in annual deficit. In fact, the operational deficit of the United States government today is over $2 trillion. So every year, we go $2 trillion more in debt. In fact, the interest on the debt now has exceeded our military spending and exceeded our Social Security spending. It's a large, large amount. The top rate today, right, this is the second reason from a fiscal backdrop perspective, is 37%. 37% historically is a low rate. That's the top rate currently. The top rate versus 70% of the last century. So the last century was 70% or higher was the top rate. Between 1940 through 1980, the top federal bracket sat anywhere from between 70% and 94%, which is crazy to say, but that's the truth. 2033, the Social Security Trust Fund will be completely depleted by 2033. So entitlements and debt service require higher taxes or benefit cuts. In other words, they're going to either have to cut benefits or they're going to have to raise taxes, or they're probably going to do, a combination of both. So the math says that rates cannot stay where they're at today, right? They can't go down, and they're probably going to have to go up. So what drives this taxation? That's RMDs. So at 73, or for some of you 75, that's when the IRS starts knocking. You can't let that money just sit and ride, right? The money has to come out. So the IRS lets you defer taxes for a while, but only for so long. Then you hit 73 or you hit 75, and now they start to make withdrawals. At 73, it's 3.8%, then it goes to 4.1, then 5, then at 85, it's 6.3, and at age 90, it's 8%. So if you've got $1 million in the account, you're gonna have to pull $82,000 out, and that's gonna get added to your income. And here's the thing, every time that you add income on top of your Social Security, on top of your pension, right? The tax liability is not just on the withdrawal, but it's also increasing the tax liability under Social Security, possibly exposing you to IRMA. Reason number 5, the widow's penalty. When one spouse passes, the survivor's income stays nearly the same, but the tax brackets shrink dramatically. So imagine you're married, husband, wife, you file joint. What happens? One of you dies. Now you file single. So you go from a standard deduction of $30,000 to a standard deduction of $15,000. And to reach that first tax bracket, it was $206,000 for 22%. And now it's only $103,000. Same thing happens with IRMA. IRMA used to be 200 and some thousand. Now it's 106. So you get hit with all of these taxes that you weren't getting hit with before. It can make as much as 5, 10, to even 15 or 20% difference in your total tax rate, which is brutal. So the 6th reason is Social Security taxation. And I think this is really important. And it's one of the most overlooked parts of our tax code. And that is that the more provisional income you have, the more your Social Security check is kept by the IRS, right? The more they get to tax you. For example, under $32,000, you don't pay any taxes on Social Security, nothing. Over $32,000, between $32,000 and $44,000, your 50% of your Social Security becomes taxable. Over $44,000, 85% of your Social Security becomes taxable. So what does that mean? That means that when you pull those RMDs out, you're forced to. That could inadvertently, and likely it will, push your Social Security and your total income past those thresholds. And all of a sudden, you go from only having part of your Social Security taxed, or none, to all of it, almost 85% of it taxed. Now, here's the thing. Only half of your Social Security income goes toward those calculations. So you can make up to $50,000, $60,000 in Social Security and not pay any taxes on it until those RMDs hit. And then you would definitely be paying some taxes on your Social Security. So you have to think about this for a second. What does that mean? That means your RMDs are not just taxed at your current marginal rate, because they also cause taxation on your Social Security. The taxation the rate on the RMD withdrawal can be as high as 40 or 45%, not including state, just federal. Because not only are you paying the taxes on the withdrawal at, let's say, 24%, you add another 14 or 15% in total taxation, which brings the marginal rate up to 40 to 45%. So this is a big deal. Those RMDs likely, and especially later in years when those RMDs get very large, they're kicking you way up in the tax brackets, and they're forcing your entire Social Security check to be taxed up to 85%, which can make a big difference in your total taxation. Again, Roth conversions will prevent that from ever happening, because the Roth, number one, you don't have to take withdrawals out of if you don't need to. But if you do need the income and you take $100,000 in a year out of a Roth IRA, zero tax. It doesn't affect your taxes on your Social Security. It doesn't affect IRMA, anything like that. All right, reason number 7, the 10-year rule. Your kids or whoever's going to inherit your qualified accounts, they have only 10 years to take that money out. So this is a big difference. The question you have to ask yourself is, how much tax liability do you want your children to inherit? That's the question I ask a lot of people. Because the traditional IRA must be withdrawn within 10 years. So if your children or whoever your heirs are, they inherit $1 million, it's at least $100,000 a year plus growth, right? So they're going to add $100,000 a year to whatever their tax liability is. So they may pay 25, even 30, 32% on the $100,000 that they're withdrawing out every year because they're forced to. So the tax liability on $1 million could be as high as $370,000 or $400,000, depending on how fast it grows during that 10-year period. Now, on the other side of it, if it's in a Roth IRA, they still have to take the money out in 10 years, but they're taking it out tax-free. And they can go anywhere from there. So they could take that money out tax-free, they could reinvest it, but the tax liability is zero. And that is a big difference. Again, you have to ask yourself this question. How much tax liability do you want your children to inherit? Reason number 8, IRMA. Your friend IRMA. So IRMA is a Medicare surcharge, and it's driven by income. And again, when you're single, all you have to do is click right over that 106, 106,000. And I've had this happen to quite a few of my clients, and it kind of hits you in the rears because it goes back 2 years, and it can be surprising. And IRMA can be as much as almost it's over $11,500 if you're married in charges. So that's almost $1,000 a month. IRMA is a big, big deal. And those RMDs are one of the first ways to click into IRMA. If you have to take $50,000 annually starting out of your IRA, chances are higher than not that you're going to click over one of those IRMA boundaries and you're going to start getting hit with those fees. And they can really add up. Again, if you're married, $206,000, right? That's $2,220 annual cost. $206 to $258, that's $3,000 a year. $258 to $322, so those of you guys that have high income, that's over $4,000 a year. And if you're over $322,000 a year in annual income, that's $5,700 per person. So you got to double all of those. So even if you're married, right, even if you go over that 206, it's actually $4,400 a year. That's significant. That's over $400 a month. So really have to think about what happens when you convert. If you convert and you're taking income out of those IRA, that Roth IRA, it has no effect on IRMA. And IRMA can stack up over you. If you look at a 25 and 30-year timeline, IRMA can be as much as $200,000 to $300,000 added to all your expenses, all the other taxes you're paying. It can be very, very significant. And again, with IRMA, I'll leave one point here. It only takes $1. If you're a single person and you make $105,000, right, $999, and all you did is add one more dollar, now you have to pay an additional $2,220. It adds up significantly, adds up quick. All right, so let's recap. What are the 8 reasons to convert? Number 1, get taxed on the seed, not the harvest. Number 2, all of your growth is going to be tax-free in a Roth IRA versus your traditional IRA. Number 3, the fiscal pressure that the United States is feeling with a huge amount of national debt and a growing operational deficit. Number 4, RMD relief. Those RMDs are going to cause all kinds of taxes and penalties if we don't do something about that early on. Number 5, the widow's penalty. You're married, one of you dies, all of a sudden you jump up in those tax brackets. Number 6, Social Security. This is a big one, right? Those RMDs could cause your Social Security to be taxed up to 85%. Number 7, the 10-year rule. How much tax liability do you want your heirs to inherit from you? And number 8, IRMA. How much in IRMA fees are you going to get hit with as those RMDs grow? And any one of these could justify the reason for getting that Roth conversion done. And most retirees face several of these. Some retirees face all 8 of them. Okay, so a common question is, when should I convert? Well, I would say this, the earlier you convert, the better, okay? But one of the sweet spots is, we call it the gap, okay? So it's the pre-RMD window. So between retirement and Social Security or RMDs, often income drops. So in other words, if you retire and you retire at 65 and you don't have to take RMDs until 73 or 75, we've got an 8 to 10 year window there to get that conversion done. And typically during that window, your income's a little bit lower, right? Because now you're living off Social Security and your pension and maybe a little bit of savings, but we're not exposed to RMDs yet, which are going to drive your income way up. I'm not saying that once you reach 73 or 75 that you shouldn't consider a Roth conversion. However, the timeline of converting will be a little bit different post RMDs. So again, bottom line, start sooner, not later. The default is this, as soon as possible, because every year you wait, the pre-tax balance grows and so does the future tax bill. The bigger the account gets, the more money you're going to pay to convert it. And again, the longer it sits in there, the bigger it's going to get. So after retirement, but before RMDs is kind of that sweet spot because your income drops, your brackets drop, right? You have a clean window to convert at the lowest rate you'll ever see. So that's the best time to do. So waiting isn't going to make the tax go down any, okay? It's just going to make it be bigger. So let's get it done now. And the next question is, how do you do it? What's the best way to do a Roth conversion? Well, first off, spread it across some years. Typically, not all the time, but typically stretching the conversion over multiple years can keep you in a lower tax bracket and avoid one giant tax gain, okay? So you either do $200,000 all at once, or you spread the $200,000 over 5 years and it's $40,000 a year. Although, if you spread it out a little bit, there could be some growth in there, so it could take a little bit longer, okay? So it's the same conversion, but we can lower the brackets by splitting it up. So there's several strategies that you can use during the conversion period. One of them is a bonus annuity. Some annuities pay premium bonus when you fund them, okay? So the credited dollars can absorb part of the conversion tax. So let's say you've got a $50,000 tax bill and you're converting 200 grand. But we got a $20,000 bonus annuity that went in, so 10% of the 200,000. So we have a net effective tax burden of 30,000 because the bonus paid 20,000 out of the 50. And the bonus doesn't pay the IRS, but it does cushion the cost of paying the IRS. So there's several strategies that you can use during the conversion period. One of those, a bonus annuity. Some annuities pay a premium bonus when you fund them. So credited dollars can absorb part of the conversion tax. So let's say that you've converted 200,000, you have a $50,000 tax bill. But you got a bonus annuity with a 10% bonus, put 200,000 in, you got a $20,000 bonus credit. So 50,000 minus 20,000 is a 30,000 effective tax burden. The bonus doesn't pay the IRS, but it's going to cushion the cost of paying it. One really great strategy is a delayed crediting strategy. And there's only one place that you can get that, and that's in an annuity. And they're either a 5-year point-to-point or a 7-year point-to-point. And I coined the name delayed crediting strategy because we're delaying the interest crediting until the end of that 5 or 7 years. So during that time period, right, we can do the conversion. So if we've got 7 years, let's just say 7 years. During that 7 years, we could have a lot of growth in the market, right? And so you might end up with an 80% crediting. And if you started with $1 million, that's $800,000 that's going to get deposited. And here's the thing. The way that's going to work is it's going to get deposited at the end of the 7 years. So if you've got all of the money converted to a Roth, that $800,000 gets credited where? Credited to the Roth. And if you have $800,000 getting credited to the Roth, how much in taxes are you going to pay? Zero. So you had $800,000 tax-free. It can make a huge difference in the total conversion cost. And guess what? Your client ends up with a higher balance, often a higher balance at the end of the conversion when they started. And that's after paying all the taxes. So that's a big deal. This is a great strategy. I highly encourage you to get an illustration and see what this looks like for your client, because this is a great way to help your client convert all of their pre-tax dollars to Roth dollars. How do we put it all together to do a Roth conversion right? We got to have a plan, the full plan. A Roth conversion isn't just one decision. It's a 4-part coordination across your full financial picture. First one is income. How are we going to affect the tax brackets? What do our withdrawals look like each year? And then the timing. How much are we converting? And how do we break it up? The cash you have on hand. Do you have cash on hand to pay the taxes for the conversions? Or do we have to use the IRA itself to pay the taxes? And it's okay if we do, but we need to know that. And then the growth. How much growth are we going to have throughout the conversion period? If you get just one of these pieces wrong, the rest of them aren't going to save it. So we got to have this, we got to get this coordinated and get it right. So how to do a Roth conversion well? We got to spread it over a couple of years. We either use a bonus annuity or delayed crediting strategy to mitigate the tax cost during the conversion. We coordinate all these things, the income, the timing, the cash, the growth. We use that strategy to turn a tax bill into a lifetime tax-free asset. So here's your next step. Run your own Roth conversion illustration. Every situation is a little bit different. The right answer comes from your numbers, your brackets, your timeline, and your goals. Nobody's situation is the same. Everybody has a different situation. So let's schedule a meeting and talk about your situation.